If you've walked through a major city lately, you've likely had to sidestep one of these, a bright green e-bike waiting for its next rider. These bikes belong to Lime, a San Francisco startup backed by Uber. They've recently filed for an IPO on the NASDAQ, aiming for a valuation of $2 billion. A $2 billion price tag typically represents the peak of success for a consumer-facing startup, a sign that a brand has successfully integrated into the daily habits of millions. 5 years ago, an IPO of this scale would have led the financial headlines. Today, it is a relatively quiet entry into the public market. The consumer tech we physically interact with is no longer the primary magnet for global capital. The largest concentrations of wealth are moving away from the street level and into a different layer of the economy. While sharing economy apps face a cooling market, capital is flowing into the invisible layer of tech infrastructure. Anduril, for instance, focuses on defense technology, specifically autonomous weapons and unmanned aerial systems. This chart shows how the valuation of a defense startup now dwarfs that of a major consumer app. Here is Lime's $2 billion target. Beside it is Anduril, which reached a $61 billion valuation. Anthropic is seeing a similar trajectory, projected to hit $50 billion by the end of June. The investment focus has shifted from the physical convenience of the sharing economy to the strategic utility of automated intelligence and defense. These software and defense valuations are built on a physical requirement. They need massive amounts of computing power to exist. This makes global chip makers the gatekeepers of this expansion, controlling the silicon necessary for every autonomous flight and AI query. This chart shows the current surge in hardware profits. In just one recent quarter, Samsung's operating profit actually exceeded what analysts had projected for the company's entire performance in 2025. SK hynix reported even more direct growth, with profits rising 405% compared to the previous year. The companies manufacturing the foundational hardware are capturing the majority of the financial rewards in the current tech cycle. Traditional corporations are now attempting to realign their operations to follow this movement of capital. General Motors is currently a primary example of a legacy manufacturer attempting to transition into an intelligence-led company. The company recently reduced its IT workforce by 10%, laying off approximately 600 employees. Simultaneously, they are hiring for new positions focused specifically on data engineering, analytics, and AI adaptation. Even in retail, the pressure to optimize is increasing. Amazon is expanding its Amazon Now service to several cities, attempting to complete deliveries in under 30 minutes. These legacy companies are reallocating their internal resources to match the market's demand for automation and data-heavy services. This data suggests that the tech industry has split into two distinct tiers. The first is the physical market we see, the apps, the scooters, and the delivery vans, which now operates with lower margins and smaller valuations. The second is the infrastructure market, the chips, the models, and the autonomous systems that receive the bulk of global investment. A lime green e-bike is a useful tool, but it represents an era of tech investment where physical presence was the primary goal. Today, the center of wealth has moved into the data center. The most significant value is no longer being created on our streets, but within the silicon and the automated systems that manage the world's information.